Let's go off the charts with John Roque of Wolfe Research. John, what are you looking at?
Hey, Melissa, thanks for having me. We've done a lot of work on the banks, and the first chart we're going to show is a chart of the relative market cap weighting for the financials. Of course, the banks are the biggest component here. And the relative market cap weight for the financials has been down for 10 months in a row. This is the worst losing streak for this group since the global financial crisis, when it went down for 11 of 12 months in 2007. We think the group's going to continue to work lower. And you could see the chart here. You haven't made any money in this sector, as the sector, for 20 years. And we're looking for it to continue to deteriorate. You don't need them is the main takeaway here.
And in terms of what this might say about the overall market, John?
So we went back 30 years, Melissa, and we found that over these 30 years, the financials were down 9 times. Coincidentally, the S&P was also down 9 times. And there was an 8-year overlap where the financials were down and the S&P was down in the same year. It has said that with the financials being weak, it's likely a drag on the market. We're going to think that our history lesson should not be lost, but we think because on the other side of it, tech continues to gain the relative market cap strength at nearly 43% in the S&P 500. As long as tech stays strong, the financials will likely be a drag, but not a killer.
And your outlook for tech?
Listen, I think this is a market where you continue to buy the winners. Tech is strong. Miners are strong. Biotech is strong. Video gaming is strong. We have an index that we call the Rich Index. It's up almost 100% off the lows. These are the winners. It's hard to sell your winners.
All right. John, great to see you. Thanks for joining us.
Melissa, thanks for having me today. Good to see you.
John Roque of Wolfe Research. Guy Adami, which chart jumped out at you?
Banks, I mean, JR is spot on. Dan, and kudos to the earlier fast pitch of Twitter, Dan Nathan, who's been talking about this for a while. I do think, by the way, that when you have earnings next week, you're going to get a bounce in these names, specifically at J.P. Morgan, because it's come from 115 down to 92 or so in pretty remarkably fast fashion. And I think you're going to get a bounce. But I don't see personally, I don't see these banks getting anywhere close to the levels we saw in January. So that's what really sticks out to me the most, Mel.
Dan?
Yeah, you know, Guy nailed the move in, let's say, J.P. Morgan. When it was back down here in the low 90s, he thought you would get a move back towards his 200-day moving average around 115. You got that. I think what's really interesting about the banks, and I agree with what Tim and Karen said before, the sentiment is really bad, especially for the money center banks. They are more tied to the real economy. And you look at the investment banks, you look at Morgan Stanley and Goldman Sachs, those charts look much better, and they act really well, and their businesses are really, really humming. So the ones that are tied to more debt and more defaults and loan loss provisions and potential bankruptcies, they act really bad. I'll just make one point about J.P. Morgan. You know, it's my J.P. Morgan indicator, I think. You know, this stock is down 33% in the year. It's up 20% from its March lows. It's down 20% from its June highs, and it's trading where it was in mid-June. It just acts horribly. If it does break lower, if it doesn't bounce, or if the bounce is sold next week, then we're really then banks are in for a lot of trouble. And I suspect they start to take the rest of the market with it, because that's a better indicator for what's going on with the real economy, rather than the liquidity-induced economy that the investment banks are really enjoying right now.
I actually sort of agree with the last thing that Dan said, which is that if the banks do go lower, and they really have not bounced off the bottom very much, it's hard to see how the rest of the market can't go lower as well, given how integral they are to the entire economy. But I actually think they'll go higher.